right, we might be flipping green here into the last 10 minutes. Stocks fighting for it. Liz Ann Sonders joins us for the big picture discussion, Chief Investment Strategist at Charles Schwab. Good afternoon, Liz Ann.
Good afternoon, Oliver.
All right, so market's trying to repair itself here. Obviously not a great start to the week, to the month, though. Give me kind of your takeaway on the last 48 hours, how we're doing so far.
Yeah, yesterday there was not a lot of specific news that you could point to define why the market was as weak as it was. Maybe some of it was just the psychology of heading into September. There seemed to be an outsized focus on a number of reports on, the September being the worst month. And I just think that may have been a contributing factor to, okay, let's just take some profits, especially after the kind of V-shaped rally we saw off the August 5th low.
When you look at the data, to your point yesterday, we didn't have much. Manufacturing was light, but we're kind of used to seeing that. JOLTs coming in a little bit lower than what we're used to seeing. What did you think about that number this morning?
Yeah, JOLTs was lower. We're under 8 million. We're back to pre-pandemic levels. To be perfectly honest, Oliver, I'm not a big fan of the JOLTs data. The response rate is down by about 50% over the last decade or so. Just the nature of how jobs are posted and essentially the free cost of those postings. I'm not sure that's all that robust. And then the metric that it's comped to, which is number of unemployed, so openings relative to the number of unemployed, one could argue that the pool of available labor for job openings is not just people who are not currently working. It's people that have a job that might be looking for a different job, another job. So I just don't know how robust that data is anymore, not to mention the fact that it lags a month relative to the other labor market data. But if you want to use it as a measure of labor market tightness, clearly things have loosened up relative to when we were looking at 12 million job openings relative to the sub 8 where we are right now. So on the margin, it's certainly a looser story.
Fair enough. Point taken. Bonds rallying, though. I got the 10-year yield below 3.75. It seems like our sensitivity levels are high then if we're kind of going for a subpar number and, running with it like bonds are here.
Yeah, so I think the weakness in bond yields is not because inflation is imploding here, but because of weakness that has started to become a bit more acute in terms of economic data. The most recent, as an example, being the ISM Manufacturing Index, which pretty much across the board was weak, and even within that, a kind of a troubling uptick in prices paid, which was a little bit odd given what we've seen in terms of weaker commodity prices. So I think this pretty steady stream of at least slightly weaker economic news, save for maybe some of the consumption data, maybe sort of elevates the spotlight on the upcoming jobs report even more with the ISM weaker reading, especially in the leading components like new orders. You did see a bit of a tick up in probabilities around 50 basis points by the Fed. Not that they key off ISM, but every new data point we sort of add to the stack in the parlor game of trying to figure out whether the Fed's going to go 25 or 50.
100%. That means tomorrow, services, they've got to come in solid, right? Like, that's our kind of one hope that's still, keeping the ship going straight.
Not only that, but I would say pay more attention to the employment component of ISM services relative to just the headline reading and whether it's above or below 50. I think it's those employment components. And I would say the same thing about the upcoming NAHB data or NFIB data, out of small businesses, because small businesses are the biggest net job creators right now. So I think all of the labor market data is incredibly important right now, not just the upcoming BLS report.
Liz Ann, what do you think we could go? I'm thinking of the right way to phrase this, because we're basically a coin flip right now for the 50 basis point odds. We've got this one big print, and then we'll have a few other residual numbers, obviously, before the meeting. But how much definition do you think Fed funds futures will have, say, 3 days out from the Fed meeting? Are we going to go? Could we be going into that meeting with coin flip 25-50? Are we going to have the first meeting in a while where we don't know what's going to happen?
Well, we've got CPI, PPI, and jobs. So those are three very important data points between now and the September meeting. And given that those probabilities adjust on a minute-to-minute basis based on Fed Fund futures, we've seen how quickly expectations can shift. Just in the last 24 hours from yesterday to today, you saw about a 5 percentage point shift up in terms of expectations for 50, down in terms of expectations for 25. So yeah, I think the needle can move a lot between now and September 18th, I think.
Okay, great stuff. Thanks very much, Liz Ann.